Welcome friends in this new episode. Today we will see something about Consortium Finance. For starting a business or an industry, for increasing its volume, the businessman needs money, investment, capital. And this investment can be either owned investment or borrowed funds. While borrowing, there are two types of needs. One is the short-term need and the other one is long-term need. For the working capital, like stock, like debtors, etc., the businessman needs short-term funds. Whereas for creating the assets, like land, factory shed, building, or machinery, furniture, etc., we need long-term capital. Generally, these business people go to the bank or financial institution for getting the funds in the form of loans. These loans can be given by the banks individually. That is, a businessman can approach to the bank, can make an application, specify the purpose for which he needs the finance, like as I said, short term or long term, and for individual purpose he may apply to the bank for the finance required. For example, I may go to the bank and say that I want to purchase a factory shed, so I need long term funds. Once my factory shed is ready, I can go to the bank again and say that I need money for machinery. I can apply for machinery again separately. Next, when I start the business, I need raw material and all, so I need working capital. I go to the bank again and make an application for working capital. This is called as the financing for a purpose. And I can apply to the same bank again and again, or I can go to another bank for different purposes. Like I can go to the bank for factory shed, bank A. I can go to the bank for machinery, bank B, and so on. This is technically called as the financing multiple banking. So I am approaching different banks for different purposes. I apply separately, I complete the formalities separately, I negotiate with the bank for rates, for the mortgage to be given, and so on. So this is called as multiple banking. I am not stick up to one bank, but I am going to different banks for different purposes. And so many banks are my financiers. This is one way of raising the money. The second way, instead of going to so many banks, what I do is, I go to one bank and few banks then come together. Considering my requirement of funds, few banks may come together and they may decide to finance jointly. It is called as Consortium Finance. So two or more banks come together. One bank takes the initiative, that is called as lead bank. And this lead bank, so I have to apply to this lead bank. Lead bank will receive the application, will scrutinize the application, will decide the terms, will complete the formalities, will negotiate with me regarding the terms like interest rate, repayment and all. And all other banks who are in consortium will decide their share. So all of them will finance me together, but each bank's share will be decided in Consortium Finance. Hence, every bank is a financer to me, but I am not the applicant separately for each bank. This is the difference between the multiple banking and the consortium financing. Friends, this consortium may take place from the beginning, or the lead bank may complete the formalities first and then find out the other interested banks to join the hands. In order to summarize the difference in the two, let me say, in multiple banking, Well, each bank independently finances me. Or in case of consortium financing, well, all these banks come together and then they finance. In multiple banking, the amount of loan, amount of finance is naturally limited. Whereas in consortium financing, well, loans of big amount, huge amount can also be disbursed. In multiple banking, one bank doesn't have any interaction with other banks because this is an independent bank financing me, which is not so in case of consortium financing. All these banks come together and they finance. Lastly, in multiple banking, the formalities are to be done separately for each bank. That is, making an application is separate, providing the documents is separate, doing the mortgage is separate, rate of interest may be different for different types of loans from different banks that I take. So in multiple banking, all these things are separately done for each bank, which is not so in case of multiple banking, where all these formalities are done with lead bank. Once we understand the meaning and the difference in the two, well, we can very easily imagine the benefits of consortium financing. The benefits may be grouped under three heads, like benefits to the person taking the loan, benefits to the bank giving the loan, and benefits to the whole economy. It is very easy to foresee that for a person who is borrowing, for the borrower, well, the advantage is for him the process is very simple. Application at one place, negotiations at one place, deciding the terms at one place, recovery also at one place. So it is very simple and it saves the time, it saves the expenditure of the applicant, of the borrower. Similarly, he can get huge amount of loan, so he can get the benefit with consortium financing. If we come to the banks and try to find out the benefits of consortium financing to the banks, then we can very easily conclude that these banks, as they are coming together, can accept the loan proposals of big amounts. An individual bank may not be able to finance on this large scale, but if they come together, they can finance the large projects. Secondly, the risk in recovery is also spread over these different banks who are in consortium. Similarly, the lead bank, if it is having good human resource, good technology for scrutinizing the application forms and completing the formalities of granting the loans, well, the benefit of this specialized knowledge and experience of lead bank can be shared by the other banks in consortium. For the economy as a whole, this consortium financing is useful mainly because the infrastructure projects or the projects where huge investment is required, well, funds are made available, financing is made available with consortium financing. Individual banks may not be able to finance such big projects or infrastructure. So once this finance is available, the infrastructure in the economy will grow, the financing for export-oriented units will grow, and with that, the economy will take shape. However, all these benefits or all the success of this consortium financing naturally depends on the ability, efficiency, and expertise of the lead bank. If there is any mistake made by the lead bank, then well, the whole consortium finance may come in trouble. In India, we have seen few banks are facing the problem because of consortium financing. Hence, there is a need to regulate this consortium financing very carefully. Thank you. We will meet in the next episode with some different concept next time. Thank you very much.